Hey, how's everyone doing? Looks like we are live and a little bit of a delay, so that is strange since this is the first time that I am streaming. But here we are to read financial statements. So, something that's actually a little more interesting than people might think. And moreover, something that everyone wants to do at some point, but might not know how. So, we're gonna start there, and let's go to the investors relations page. So, this is always where you want to start at investor relations, and it'll show you all the different. Let's see, we'll allow it this time. Yeah, so wow, lots of cookies and preferences here. Fun stuff. All right, so investor relations, we're gonna do Build-A-Bear today, so that will be fun. And we get to see the executive leadership. But right now, we really just want to find their financial statements. So, a little trickier than I thought, and this is good, I guess. Gives us a chance to try to find what we're looking for together. Um, all right, so we are going to go back a step and find their 10K report, since that's usually the annual statement. So um, find it maybe through sec.gov. Here is a 10K statement. Now we're going to make sure the address is or the date and time is most recent. Interesting how difficult it is to find that. So let's see. Yeah, I don't see a date anywhere on there. Maybe the final page of the signatures. So April 13th, 2023. So might be an older one. Let's see if we can find a 2024. Type that in. Um, hmm. Usually you can find it on the investors relations page. All right, so we missed it the first time. Very small link there. Let's see. All right, so I think we have SEC filings, and that just goes to show how sometimes even somebody who knows the information they're looking for might have trouble finding it. All right, so statement of changes in securities filed by insiders. So this is just people selling their stocks and they have to report it. Um, so the 10Q. But we saw that the 10K was filed in April of 2023. So I imagine in April of 2024, we're going to find the 10K report. So keep going down, and it just goes to show there's a lot of forms that they have to submit. Although honestly, most of them seem to be reports about changes in the executive leadership stock ownerships. But anyway, we have found it. We're going to go to the PDF version here. Definitely going to need that to be bigger, both for. Oh, let's see what's going on here. We need to get rid of this thing on the side. How do we do that? Let's see if we can drag and drop. All right, so a little tougher. See if we want to get rid of the annotations. All right, there we go. This is always a lot harder than you think it'll be. All right, so we've now found the 2024, and if we go look at the signatures this time, they don't exist. Bit odd. I guess there's probably an addendum or something. So anyway, we see these dates now, 2024. We have not even gotten started here, and it has been difficult trying to find everything that we're looking for. But anyway, trading symbol BBW for Build-A-Bear Workshop. I chose this one because it's slightly retail, but it's also an experience. And I think, experiences have a chance of surviving the technological age. It gives parents an excuse to put down the phone and go do something in person. So let's see what we've got here. So we got the table of contents. Part one, business, risk factors, unresolved staff comments. Curious to see what that'll be. Cybersecurity, which will likely be boring for us. Mine safety disclosures. That seems like a government regulation. Don't think it pertains much to Build-A-Bear. Down here, I notice we have our exhibits and financial statement schedules. So that's probably where we're gonna end up, page 40. Let's just skim down. So forward-looking statements, the ones that say I'm not your lawyer and not financial advice. This is basically that, but for an SEC report, basically saying the future is unknown, even though the point of this report is supposed to shed light into what the executives at Build-A-Bear think the future will hold. So this just explains a little bit about Build-A-Bear, which is actually pretty good for us because I'm not as familiar with it as I should be since I'm using it to demo how to read financial statements. But and I've never been in, never bought one, but they have 525 global locations, some managed by corporate, some by partners, whatever that means, and then an international franchise model. 359 are owned by corporate, 320 of those in the United States and Canada, so North America, and 39 stores in the UK. So they must have pretty decent global footprint with the 92 partner locations elsewhere. Wow, a lot of math already with these basic numbers. 74 franchises operating internationally. In addition to these stores, they have an e-commerce site, third-party marketplace. So, good information already. For the 2023 fiscal year, the company had net new unit growth of 37 experience locations, 9 corporately managed, 22 partner locations. So already there, we get some insight on something that's happening at this company. So you notice how they have 359 corporate owned, and we see here, let's see, it's hard finding these numbers. I'm trying to figure out how many are partner owned. So we have 359, 74, 92 partner owned. So we see a growth of partner owned partner owned locations growth is about 20%. 22 extra compared to the 92, whereas their corporate locations only have a growth of about 10, maybe 11%, rising from whatever 359 minus 37. So they had 322 locations, now they have 359. So I think that's a really interesting takeaway right there. Also interesting, when these reports were done, you can imagine being an employee having to count up these numbers, and you did that work on February 3rd, yet this 10K was not released until middle of April. All right. So descriptions of the operations, interactive entertainment experience, which is what I was saying. It's not fully retail. It's a little more than that, both physical and digital. Range of consumer segments. Omni-channel. So they like to use the big words, but we'll find out more how these channels operate in this report. Vertical retail chain. So vertical means that, for example, maybe they source the cotton, and then the cotton comes to build the bear. That would be one method of vertical integration. So that's the vertical, meaning that the supplies come from the company, and then they sell the bears, which is a second part in the vertical chain, etc. I'm gonna have to learn to use that mute button, but this is my first time streaming, and with all the current viewers we have right now, I'm not too worried. All right, so we continue to read the description. Um, Stuffing, fluffing, dressing, and accessorizing. That would be the name of my four-piece band there if I had one. And if we got a fifth member, we would change it to stuffing, fluffing, dressing, accessorizing, and naming of their own teddy bears, stuffed animals, e-commerce sites with gift giving. Makes sense. engaging digital purchasing experiences, Bear Builder, an age-gated, adult-focused Bear Cave, and the Heartbox gift site. I'm not going to go there right now. You might want to pause the live stream and check what those are, but that sounds interesting. Retail stores also act as a mini distribution center, so trying to create some synergy within their building and save some costs by not having extra distribution and inventory outside of the retail locations. And there we go. We got our omni-channel support. So that also acts as their inventory for the digital demand. Pretty interesting. And, if they ship from those local locations with 320 stores in the US, it means that there is probably a location near you for quick and efficient shipping on the digital demand. The primary consumer target is families with children. Makes sense. Primarily tweens, teens, and adults who are the gift givers. And that's an interesting one how, adults might not build a bear, but the tweens might come into the store to build a bear for Mother's Day or something like that. So I'm sure their business model takes that into account, which is why tweens are the primary gift givers, as well as kind of the demographic in store being the children attached to these families. So we learned a lot just from this first page. Um, Engaging content, wonder what that means. I guess if the building is the content, but not sure if they have any cartoonish type stuff that helps build their marketing campaign and maybe could become a source of revenue and advertising. Outbound licensing agreements with leading manufacturers. So, I'm not sure. There's nothing, no intellectual property that Build-A-Bear has really built up over time, at least that I'm aware of. And that seems like it would be an area where they could really find some success in. All right. So, operating strategies. We're not going to read this stuff. Drive. It's all buzzwords. Drive profitable growth. Um, I guess that is better than the companies that drive growth and lose money all the time. Um, Maintaining commitment, return capital to shareholders. So I did look before I jumped on at their recent chart. So this is their 5-year chart. Definitely, has been on the upward momentum. $2 back during the pandemic, which I guess makes sense. An in-person experience, not the greatest. So it's more 10 to 15x since then, and it does pay about a 3% dividend rate, with earnings per share of $3.50. So, in all fairness to them, it does seem like they are driving that profitable growth, with such solid earnings per share there. Merchandise sourcing and inventory management. Lots of regulations that they're abiding by. Hopefully that's good. Average time from project completion to arrival in stores, 12 months. So they update their product assortment. I'm not sure if there's style patterns that go along. It's not like necessarily high fashion that they have to, get their trends from New York Fashion Week, but maybe there is something that they try to apply from current events, memes, things like that into their Build-A-Bear. Not sure. Their inventory balance, and we're going to see this more in the financial statements, but $63 million, a decrease of 7 million. So that's good. You want them to run tight inventory as long as that doesn't impact their ability to have stock on hand for their sales. So, if you can see inventory going down but sales going up, that would be a pretty good metric. They do own a distribution center near Columbus, Ohio. Um, we got the Columbus Crew playing the Philadelphia Union tomorrow night, so that'll be a fun battle there. Contract 1-year term and is renewable. Then they have some European stuff in England. So nothing too interesting here. Third-party logistics for their transportation, and we're not digging too far into the whole company. Just want to see a little bit what they're about. The the employee who had to do all the data, including figuring out the data on the number of employees. Um, Interesting that they have so many part-time employees. This is probably the trend for their retail workers, so they don't pay them benefits. So not necessarily the ethics that we want to see, but we are making an assumption of that. But that's interesting how big their part-time employees are, and none of their employees are represented by a labor union. Um, Basically what I would like to see in the future is this number go down for part timers, increase the full timers, and then maybe automate a little more. So, the automation will save some money, but it'll also open up, the fewer spots can maybe be more full time, and they can shift those compensation and benefits from not being given to the part timers to be giving to a few more that are full timers. Competition. I have, I'm closing my eyes right now. I am trying to think who the competition for this would be. Claw machines in arcades. Certainly like Thai Beanie Babies. Collectibles like trading cards, maybe. But this is definitely an interesting niche that they have carved out. So you might have been reading as it's on your screen, but I was not. So who are their competitors? Um, it is distinctive combination of entertainment and retail. I will give them that. Small companies that make your own teddy bear and stuffed animal stores. So, I was talking about intellectual property. Certainly, the name Build a Bear is worth a lot because we're all familiar with that. So, there can be other build your owns that don't infringe on that trademark, and we'll go over different trademark things and the like in time. Um, all right. So I've realized that we're categorized as people and blogs, but definitely think we should be in the education category. So going to change that to education. I'm sure now we'll get a lot of viewers. Um, all right. So 1-800-Flowers, Vermont Teddy Bear, Funko. Forgot about Funko. They're an interesting type of collectible. And then entertainment venues. So yeah, and then Ty for the Beanie Babies, Mattel. So they definitely are at this nexus of entertainment and retail that, it's done well for them on their share price and their earnings per share, and yeah, good for them. So copyrights, patents. So that's interesting that they do have patents in the year 2032 and 2033. So probably too far in the future for it to matter on their financials. But in the next few years, that'll become more and more important to know what those, um, you know, patents are. And then they license out a bunch of various brands and whatnot. All right. So risk factors. Really curious about the risk factors here, but I don't want to keep you all day as we get to the actual financial statement. But um, global economic conditions are always a risk. Inflation, definitely a big one. Recessions, weakened economic conditions. So curious how they think inflation might impact them. Price increases. So that'll keep the spiral of inflation happening when you expect inflation and set your prices higher. That then in source creates inflation. So let's see. Expect the inflationary pressures experienced in fiscal 2023 to decrease, but continue into 24, and they'll continue to monitor it. So nothing too interesting there. All companies probably have that macroeconomic risk. Consumer interests can change rapidly. I mean, I don't see Build-A-Bear as uber trendy. So I think that's to their advantage that they'll get their continual trickle of new customers. And, if you think about it, new families having new kids will need new Build-A-Bears and new experiences. So I think that constantly renews. But let's see what they say in their risks. Licensing the IP of the other brands. converting customer awareness into store visits, identify the optimal level of marketing spend. So, again, doing their job effectively, deciding where to put the stores geographically. So, again, nothing managing their marketing costs. So, we see marketing basically in the first bullet with greater awareness, consumer awareness, optimal level of marketing spend, and then effective managing marketing costs. Feel like this employee had to come up with six different bullet points because number three and number six seem pretty similar. All right, so we could look at some more risks here. We depend upon shopping mall and tourist locations. So it's really interesting. That's a good risk of if you have an empty shopping mall, no one's going to randomly stop by the Build-A-Bear. So how can you attract foot traffic? And right then I see the word decreasing consumer traffic. So that's a real interesting one. Let's see in this small print if there's anything about how they plan to maybe increase it. They don't control the mall supply and demand. Um, losing anchors and other tenants isn't great. Um, Pre-pandemic levels. So, nothing really um, strategic in this, and that's something that you want to look for. And maybe they're just not sharing that strategy with the shareholders, but it just kind of makes me wonder, like, what are they doing to turn that negative risk into maybe something positive where they are planning to be in locations with foot traffic. I mean, I just thought of an idea. I mean, how many Build-A-Bear shops do they have at different sporting stadiums and concert venues? That could be a source of income. So there's a lot they can do, and I'd like to see in the risk statement what they're doing with their strategies. Profitability could fluctuate due to premium petrol oil prices. So you don't realize it, but these companies they all use a lot of gasoline. Maybe the plastic is dependent on oil prices. So companies just have so much going on. 3,000 different employees or 4,000, I forget what it was. Um, what else? Competitive threats. So they kind of talked about their competitors. Could there be another brand that does a make your own? And I'm thinking something maybe with digital. Maybe, if we get a group of people watching this that want to take on Build a Bear and create our own stuffing experience retail, I'd be open to listening to how we could make it better. Um, Gift giving. Other companies have longer operating histories. I don't know if that's actually a benefit for those older companies. I think being relatively newer has its positives and whatnot. Um, Curbside pickup, that kind of defeats the experience part of Build a Bear, but so does the digital as well. Health pandemics. And, this one's interesting to me because I bet this was not on their risks in 2018, 2019. And so it just shows how reactive people are in creating these financial statements and these, when they're looking at the risks, are they really taking the full breadth of the risk? And, you know, I'm curious to see if terrorism would be on here, and it's not. And that's because we haven't had a major incident in decades. So again, you want to make sure the risks are actually in play before they happen and not just reacting after it happens. Because if they had put this risk in 2018-19, it'd have been really uh, scary for them because again, their business is about that in-store experience for the most part. Operational risks. All right, so let's. Oh, well, sorry. All right. Unable to generate interest and demand for their interactive retail experience. Yes, I mean, these risks are a little, they're just so mundane of the risk of our business not doing well. Like, that's the whole point of a business. You need to be able to do well. Store leases. So this goes back to location and foot traffic. Um, I think that is a really important risk as they've already identified. Interesting one here. They could violate the terms of their current lease. I would hope that they'd have better compliance than that. But it is interesting that they put it down. Several landlords dominate the ownership, um, and they're dependent on those landlords. So good relationships, so that is interesting. Um, and then, not I'm not as familiar with the European markets, but provisions requiring rent reviews every 5 years. So yeah, some good nuggets there. Looks like there's a little space in there. Not sure how that happened, but failure to successfully execute. They love the omni-channel word and brand expansion strategy at the cost of investment in e-commerce. So yeah, how will they, become more digital? The better you are in that direction, you'll do better in this 2024 decade. Strategy includes investments in e-commerce. I'm sure their strategy is probably uh, very Web 2. What was going on before the dot-com bubble in 2000 is probably how they deal with their digital strategy. I would like to see something newer and more bold and innovative, may not adequately allow them to increase sales. Adult to adult giving, Heartbox, adult driven affinity, the Bear Cave, and a cave. So very curious now the difference between the Bear Cave and Heartbox. So I wonder if Heartbox is romantic, whereas the Bear Cave is more family based. Uh, Seamless omni-channel shopping experience. So they're not giving us much there. Capital expenditures focused on digital initiatives, um, risk with technology and digital operations. Um, yeah, computer systems. We saw what happened with oh, not Cloudflare. I apologize to Cloudflare that's who I thought of, but the other C word, channel stream, stream. I don't know what it was, but it shut down a lot of different websites and technology. So yeah, that is definitely a big business risk. The hackers shutting down certain companies, requesting demand. There was also that Sony incident, which was not good for them, where all of their corporate stuff got made public. Um, Whereas with these 10K statements, they're very careful what they choose to make public, even though they're supposed to make everything public in a certain due diligence sort of way. All right, lots more risks here. Evolving store locations with market trends, distribution channels, international risks. I'm sure currency is always one of those as well. Um, yeah, it's harder to manage those different areas. I have my dog Izzy with me. She is wanting some attention since we've been on this live stream pretty long. Um, so I'll give her pets as we read through the rest of these risks. Foreign manufacturers is another risk. Effectively manage their property locations, legal and IP risks. You can see how you could spend the day kind of looking at this stuff. And it's why when you buy a stock, you're probably not digging in far enough. But, it is a balance of how much time you have and how much you can actually get from these reports. But if they fail to protect their trademarks, that's a risk. Let's assume that they'll be diligent on that. Negative publicity here. It's an interesting risk if you think about it. Lawsuits, more negative publicity, risks related to owning the stock. So yeah, a lot of good stuff on the risks. We're going to move fastly through this stuff about their bylaws. We talked. We saw the cybersecurity in the table of contents, and like I said, if you're interested in cybersecurity, you can maybe I'll partner with you and you can do a chat on what this stuff says. But for now, we're gonna kind of skip over it. Their properties, um, really interesting. The warehouse and all of that stuff. Legal proceedings. So, some lots of dog hair here. Lots of dog hair. Love you, Izzy. Um, so the mine safety disclosure not applicable. Legal proceedings. And if you do hear some scratching, she is uh, making her bed on the tile floor right now. But it doesn't look like there's any lawsuits at the moment. Their current stock trading as BBW. Only 1,864 holders. And my guess is because that includes all the brokerage firms and not individuals who hold shares at the brokerage firms. But either way, that's still a surprisingly small number. So that is intriguing. Um, so you got to be very careful here with the units. Are these hundreds of thousands of dollars, millions of dollars? Um, be honest, it's not very clear. Are there really only 223,000 shares? This stock has been up so much over the last 5 years that the reason I wanted to do this one is, right now, full disclosure, I don't own any shares, and I'm not really looking to, own any shares in Build a Bear. But perhaps, I'll take a long or short position on this at some point. And I'll update it in the comments, I guess, if that happens. But yeah, no interest, just based on how much growth they've seen in the last 10 years, and the risks of the mall closings, and things now returning more to a pre-pandemic level. Everyone, not rushing out of their home since they are no longer stuck in their home 24/7. Share repurchase, $50 million. Yeah, so I'm just trying to figure out maximum number of shares that may be purchased. So this is the share buyback, I think, and that's the 50 million would be my guess. Um, yeah, so this is all just share buyback, I think. All right, we move on. All right, so we're not going to read through all of this stuff. So this is basically the prose version, PROSE, of their financial statements. Um, we're going to skip over that and actually just go to the appendix that has the financial statements. Um, so my nose always itches, and I think maybe it's because of the dog hair. That would make sense. Uh, Public accounting firms, they do a good job of auditing most of the time. The problem is if there's one report that is not appropriately audited, then that would be bad if it was the company you're holding and it had an adverse effect on the stock price. And we obviously saw that happen with Enron and all those others. So actually, I accidentally went to the bottom here looking for those financial statements. Let's drive back up to the table of contents. So exhibits and financial statement schedules. So as we just were looking at, it has the report of the auditor. And we finally get into our first statement. Didn't think it was going to take 33 minutes, did you, just to get to the financial statements? But we are here, which means we'll finish this in under an hour. So, all those viewers, please hold tight. We will get there soon. And maybe in this next half hour, now that we're actually doing the financial statements, we'll have somebody join us. So balance sheet. You have assets on one side, liabilities and stockholders' equity on the other side. You can kind of think of it as assets on one side, and then on the other side, you know, some of that is balanced by liabilities, the bad stuff. But, as long as you have more assets than liabilities, then you have some good stuff left over for the stockholders' equity. So, let's see what they have in current assets. So cash equivalents. So this can even be bonds and stuff. It just means that if they need money, in a couple days they can turn whatever that is into cash. So they had 42, and I'm assuming this is millions, so dollars and thousands. So they had 42 million in cash, and they've grown that to 44 million. Their inventory did go down 7 million. So notice how we saw that in the beginning and of the report. So that probably is a good thing. Um, cash receivables, account receivables. So the receivables are when they bill somebody. So for example, maybe they do a partnership with Lady Gaga's concerts, and they provide $10 million in bears, and they don't get paid for that. They send a bill, and until that bill gets paid, it's counts as a receivable. So I'd be curious what they are receiving large amounts of payment for. I guess it could also be maybe with like credit card vendors or something like that. So, I mean, it's a positive direction. You don't want a lot in receivables. You'd rather have it as, a cash equivalent. Prepaid expenses and other current assets. So this would be like paying rent and stuff. To be honest, this going down is not necessarily a good thing because you want the total amount of assets to be high. We do see that their current assets went down $20 million. Um, you know, it's really just a category. Let's see how the rest of the balance sheet looks. Um, Operating leases. So that remains mostly unchanged. They bought $5 million worth of property and equipment. Could be something like forklifts in their warehouse. Who knows what else it could be. Deferred tax assets. So this would be, I guess, refunds that they expect later on. So that going up is good because it is an asset. And then 3 million in categories not already shown. So their total assets went down $8 million. For the most part, I'd consider it mostly unchanged. Let's see how their liabilities doing. So accounts payable, they owe $6 million more in bills. That could be to utility companies, things like that. Accrued expenses, a little different than accounts payable. It's an expense where they uh, got the benefit of something, but they haven't been given the bill for it yet. So example of that might be, um, you get a utility bill every month. That would be in the accounts payable, but maybe it's the 26th day of the month. So you'll get a bill on the 30th, but those 26 days of using utility would be an accrued expense that'll eventually become an account payable. So their accrued expenses down $20 million. Not really sure what that could be about. We do have that section of words where they might explain this stuff. So we'll look at that later. Operating lease liability short term, mostly unchanged. Gift cards. So this is a liability. It means they took in that cash, but if the person then uses it, they've got to provide them with that inventory. This one is probably not a terrible liability for them to have on the books because after a certain amount of time, those cards might expire. They can write them off. So this can quickly move from a liability to off the balance sheet entirely. And if this moves off the balance sheet, it doesn't necessarily become an asset, but it would yield larger shareholder equity. And then finally, deferred revenue. Um, and that's down. So their liabilities are down 17 million on the current liabilities. Their operating leases mostly unchanged and other long-term liabilities. It's interesting they're not carrying a lot of long-term debt, or I guess any debt whatsoever, really. Only $1 million. So that's a real positive that if they do experience headwinds, they're not going to be in much trouble. They'll have 44 million in cash to handle what comes, and not a terrible amount of liabilities, in response to that. Um, you have 35 million here in accounts payable and accrued expenses, and then they're going to have to pay their leases. So yeah, all in all, I think it's a pretty healthy balance sheet here. So we see their total assets of 272, whereas their total liabilities only about 57 million. Um, Thing is, again, it's more about looking at these current assets of the 44 in cash and the receivables. offset by these current liabilities. Stockholders equity. Sorry for that long pause. So you have preferred stock, 15,000 shares. You have common stock, 50,000 shares authorized, but only 14,000 outstanding. And issued, they have no shares issued or outstanding of their preferred. So I'm not even sure if that class fully exists. So they have 14,000 shares issued and somehow more shares outstanding than they have issued. That's curious. As we saw with GameStop, though, maybe it's short interest or something to that effect. Additional paid in capital. Be honest with you, I'm not quite sure what that means. I've never really understood the stockholder equity side of the balance sheet as much. Retained earnings is good though. That's money that's not in a liability and is tucked away in an asset of some sort. So for example, if they had no property and equipment, that 55 would go away, and this 75,000 in retained earnings would become 25 million. So the fact that there's 55 million in property and 75 in retained earnings means that if you wanted to pay the shareholders out the retained earnings, if you could sell that equipment for 55 million, then you would have the money that would, be able to pay for these retained earnings. So it's an important line. And we see stockholder equity of 129. And then the reason it's called a balance sheet, this 272 has to match this 272. So, like I said, we'd get through this in the hour because we are done the balance sheet. All right, so let's move on to the income statement. Forget what this is called in the UK, but I did do some UK financing, and it was interesting how all the terms they call it turnover is one of their things that are used, and then they use a P&L, profit and loss statement, I think, for the income sheet. So if you haven't been able to tell by my accent yet, this is a very American based, and that's why we're looking at American held Build-A-Bear with their Ohio warehouse. So, revenues. Revenues is the money that is coming in. Net retail sales. So it's up 10 million. Yes, there's in thousands. So it's up $10 million. That's good. Commercial revenue. And like I said, now I'm curious. 18,523. We look up here the receivables. So whatever this commercial revenue is probably what's related to their receivables. And the commercial revenue is up $7 million. International franchising, very small amount. And they talk about publicity and everything. It almost makes you wonder if it's worth the international franchising for such a paltry sum, 1% of their net retail sales, but it probably does have much better margins than their retail sales. So 4 million there. So total revenue is up. Again, this 7 million in commercial revenue is responsible for 40% of their growth year over year. So that's really fascinating since commercial revenue is so small. And the question is that 7 million a blip, or will this line item keep growing? And someday match up with their net retail sales. So this could be an area where they really, deeply succeed. So again, total revenue up 20 million bucks. Nothing to sneeze at. Costs and expenses. So cost of merchandise sold, 206. I'm assuming the merchandise sold is um, I'm assuming that that has nothing to do with their leases since we saw that in the other statement. But maybe it includes overhead. So we have their consolidated gross profit, and then we have the selling general and administrative expenses. So that's where the overhead, such as leases, should be. So yeah, let's return. So retail 206,000, um, commercial 12,000, and cost of merchandise for the international franchising 2.8. So it's interesting. I mean, you basically can see the margins on their bears. 206 divided by 456. So they have about 60% margin there on a bear. 12,000 divided by 25,000, close to 50, and 2.8 divided by 4.5. So retail does have the best margins at 60. Commercial at about 50, probably because they're giving discounts out on the pricing, maybe because it's bulk sales or something like that. So that makes sense. And then international franchising. I mean, the international franchise has to make money somehow. So not sure why. Could also be currency risk, different currencies on the international side, but that's only about a 40% margin. Um, so gross profit, it sounds like it's really important and it sounds like it's profit, but again, it doesn't include that overhead. And the nice thing about a retail like this is that it is very simple statements. If you looked at maybe an insurance company or a tech company, the line items might not make as much sense. And it's real nice how one-to-one matchup on the revenues and the cost of merchandise sold here. So other expenses, we'll just call this overhead. So that's going to include salaries, utilities, all of that stuff, 198 million. Interest expense. So um, again, they don't carry a lot of debt, so their cash is bringing in 929 $100,000, so less than a million. I do wonder if they could invest that money a little better on their 44 million in cash. But I guess 2% just seems a little weak with bonds at 4% and that sort of thing. So a little curious there. But that does give income before taxes of $66 million, up 5 million over the course of the year. And, of course, their overheads up 15 million, their merchandise costs, 20 million more. But all in all, since all of those percentages kind of remain intact, since their total revenue grows, so too does their income before taxes from 62 million to 66 million. And then they've got to pay their income tax. So we see that it brings it down to $52 million in net income, currency adjustments, and that's how they get their $3.68 per share. So very straightforward and really solid. I don't see so far in this report any real strategy for growth, but at the same time, it looks like if they just keep doing what they're doing, they will deliver on their dividends, and keep at least a steady stock price. So real interesting so far. And by that I mean it's not so complex that it's confusing. So it's very simple that we can understand this. All right, now we get to the statement on stockholders' equity. Not going to spend too much time here. It's not my area of expertise, but they do have their dividend payment, the share repurchases, all pretty interesting. So, balance of the shareholder equity 93,000, some retained earnings, some comprehensive loss, the additional paid in capital. So the net income that we saw in the statement above of $47,000, I'm hoping, yep, it matches. Well, 52,000 here, and 47,000 here. So not quite fully matching, but might relate somehow. All right, like I said, not an expert on this. So here's the net income of $52,000. Um, Not sure the difference. Oh, so this was 2022. This is 2023. And then, so this is everything that happened in the year we're looking at. And this above it is the previous year. So here's the net income that goes to the retained earnings. The cash dividend does come out of that. So, real interesting here that they have $52,000 of net income. They invest 16,000 into share repurchases, which makes the stock price grow, um, and then 22,000 in cash dividends. So you can almost look at this as a $38,000 cash dividend, or $38,000 quote dividend. The 16,000 is going to your capital gains, the 22,000 as a true cash dividend. But the share repurchases might be better for your capital gains taxes, as you can wait them out as long as possible. All right. Finally, move on to cash flows. Again, they seem to be a pretty responsible business from what I'm seeing. So let's let's see if anything else pops out. So we start with their $52,000 in income. Depreciation, this is not a topic we're going to cover today. It deals with taxes and not just taxes. Personal taxes deals with depreciation, but for them, that equipment, that 55,000, is it an asset, a liability? That's pretty important. So depreciation is good for the bottom line. Share based and performance based stock compensation. Uh, Rather, the depreciation is bad for the bottom line since the positives do end up getting subtracted out. All right, so changes in assets and liabilities. We could look, but we kind of talked about this. Inventory went down $7,000. So that's an asset that's no longer on the books, which again, it's not necessarily a bad thing, but it will reduce our cash flow here. Um, the gift cards, the deferred revenue. Um, so all in all, cash on hand, 44,000. So it's really just telling the story of how, we get from one place to another. And so, we already knew that they had $44,000 cash on hand. So this really doesn't tell us anything new. Um, Financing, we mentioned how, let's see. Investing, capital expenditures, $18,000 in the negative. Um, Cash flows, proceeds, purchase of companies' own stock. That's the share buybacks, the dividends. Um, so yeah, and that's really the third piece here that they're using the net income for. They're doing the share purchases, the dividend, and investing in the capital. So that kind of explains most of where that money is going. And then they had to use some of the cash to pay their taxes. So I think we're winding down here. Um, Now lots of statements about each of the categories. Um, oh, it's actually not about the specific categories itself, but just how they um, consider those categories. So uh, it's either lowest the cost or the net realizable value. So interesting there. So the cost might be $5. If you had a product that was originally $10, then the inventory would count as $5. But if they started reducing it, so they're selling it at $3, they could still count the inventory as $5. So, that's again something that happens with the numbers. You got to really figure out what's going on underneath them because yeah, I mean, you might only be able to sell the inventory for $3, but it might be calculated at $5. And expand that by millions. 50 million in inventory when it can only be sold for 30 million. That would kind of um, that would be a $20 million difference that's not showing up in the financial statements. They do have a reserve for estimated shortage. So I imagine that's from theft and fraud and just outright like breaking and damaged goods, etc. So good that they have a reserve for that, and that's kind of calculated in. So we definitely could look through the leases, long-lived assets. I kind of want to, before we close out here today, go back to the top and see what they said for all of those categories. So they kind of have some color on some of the things we were trying to figure out, and so maybe there's some interesting tidbits that we can close out our discussion with today. A lot of it's going to be repeats since we already looked at the financial statements themselves. So this is where we left off right here, and then management talks about their business overview. Um, and we looked at the business overview, direct. So they get a little more detail, somewhat repetitive, but the direct to customer, they do explain the commercial. So other businesses, so that could also be, if there was a special bear at, um, I can't think of a good example. I already said like sporting events and stuff, but maybe, um, McDonald's wants to have a Happy Meal toy or something, and they do a Build a Bear, and um, maybe McDonald's pays for the pleasure of that. I doubt a company as big as McDonald's will, but maybe there's, Joe's Burgers, who wants to do a Build-A-Bear promotion, and they buy the product. So that would be that, and then royalties as well as the product and fixture sales is the international. Oh, dog hair. But my Izzy girl is laying down on those cold tiles, so she has not come for pets lately. Revenues, we see it broken out by North America and United Kingdom. Um, Net retail sales per square foot. So per square foot, and this could just be because the UK has a smaller footprint in their stores, yet they sell the same amount of revenue. Maybe land is cheaper in North America, so nothing that really jumps out there, but it is kind of interesting. They talk about their cash. So let's see here. Yeah, nothing special. Or cost of merchandise sold includes licenses. Cost of merchant. So that is a real interesting tidbit. Is the cost of merchandise includes the licenses. Yet retail still had a very um, high margin, so nothing too bad there. Store depreciation, store asset impairment charges, cost of warehousing, packaging, stuffing, damages, shortages, shipping and handling. So, we didn't quite realize that was all in there. I wonder if the shipping and handling is what's affecting the international margins. Selling, general, and administrative expenses, payroll and benefits, advertising, credit card fees, store supplies, um, central office. Doesn't talk about the leases, legal and public relations, information systems, appreciation of central office assets, store expenses. So interesting. Company managed locations, they just do the numbers of those, third party, international franchise locations. So 21 in South Africa, 20 in Australia. So clearly, big in the English speaking markets. I wonder why they haven't explored maybe, the other language markets, namely Spanish speaking. But yeah, so 21 and 20 there. Australia includes New Zealand, only one store currently open. Um, there are three major cities in New Zealand, I think, so some room for growth there. China includes Hong Kong, so again, more English speaking, and then the Gulf states. I do believe they have fancy malls there, so where the mall space is, Build-A-Bear probably goes. Results of operations. So again, the reason we skipped all this, I don't see too much different than in the actual financial statements. A lot of repetitiveness, but some new charts as well. So we see impairment, total revenues, and this must be changed because it's a negative. Net sales increase, the components of this increase. So existing stores are down. E-commerce, which shows they just absolutely need a digital strategy, down 3.2. New stores is the reason for their growth. So, that's a little worrisome because you just can't have new stores forever. Store closures, so 3.3 growth there, and the e-commerce down 3.2, no growth from their existing stores. We talked about this gift card breakage, so eventually that will keep declining from a liability into I guess, revenue. So 1.2 there. Foreign currency was favorable. And then this eliminates pretty much all their growth. The fact that it was just due to accounting, 7 million just because there was a 53rd week. So 365 days in a year, you divide that by 52. And I don't know what that is. So that's 364. So every, seventh year there is a 53rd week, and it's very interesting that that's where most of their growth comes from. I'll make a good video sometime. So now we read and see if there's any new information here. No, I mean that was absolutely fascinating and worth the final dive in. This shows exactly what's happening. Pretty much just, you know, their growth is really just from new stores, and they just absolutely need a digital strategy. And this would prevent me from necessarily wanting to invest in them right now, because you need a digital strategy, or if they had some strategy with how they were going to, invigorate new stores into different foot traffic patterns. Again, the foot traffic is obvious because they're not growing from the existing stores. So very, very interesting story there. And I feel like we should end the live stream there because I'm not sure if anything else interesting will come, but we got to keep looking until the end here. Um, so almost $1 million of interest. Um, and that's just disappointing. I just feel like they could have a little more interest there. But retail gross margins, 6.2%. They increased to 54% from 52. And that's what we're saying with the cost of goods sold. You could see it was about 50% across their three lines of business. Income tax, non-GAAP financial measure earning. This is your EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization. So we are just crossing the hour mark. I promise you, we'll get you out soon here. Income before taxes, their interest, the depreciation, earnings before interest, tax, depreciation. Um, liquidity and capital reserves. Like I said, they have a good amount of cash on hand, so I wouldn't be concerned about that right now. Keep moving down. They talk about leases there. Inflation, accounting policies, long-lived assets, revenue recognition. So I'm moving through this stuff fast, and that's not there. There could be valuable information here. It just takes a lot of time, and charts are just so much quicker to find the information. So as we're on a live stream here, I don't want to bog us down too much learning about all their income taxes. So I think we are at the end. Just want to thank you so much for you know coming along for this live stream. Um, the takeaway from this, hopefully you learned a lot about how to read a 10K report, how to read the financials, and all the financial statements. This is a company that will monitor closely throughout the next, 24 months to see how Build-A-Bear does. So thank you so much. I hope you learned something, and maybe we'll pick another company, and we'll read those financial statements of the next company next week. So if there's a company you would like us to look at, please hit us up in the comments. So this is Joe Davis. Thanks for watching.